Good afternoon, everyone. My name is Alex Sunners. I'm joined with my colleague here, Drew Tignanelli, and we've got a fun topic today. We're talking about the top tax moves you should be making before the end of the year.
Yeah, that is fun, Alec.
So, today's agenda, we're going to go through two different things. The first thing we're going to talk about is just some tax basics, understanding a couple different things about tax laws and how they work. And then we'll jump into 10 different tips to minimize your taxes before the end of the year. So with tax basics, there are two things we want to distinguish between a marginal tax bracket as well as the difference between a gift tax and income tax. That can be confusing for a lot of people, so we want to make sure we cover that.
Because most people don't even know that a gift tax exists. So that's why it's confusing.
Yeah. So we'll go through that and hopefully explain that so everyone can understand. So, starting with marginal tax. Marginal tax is when you hear someone talk about tax brackets, what tax bracket they're in. That's sort of what marginal tax has to deal with. And when you look at the chart here on the right, these are the different tax brackets at different income levels. 10% tax rate for 0 to 11,000 for single or 0 to 23,000 for married, and they go up from there. Moving into that next tax bracket does not mean all of your income then starts getting taxed at that higher rate. So in the example of, okay, you're single, your income goes up from 45,000 to 50,000. You jump from the 12% bracket to the 22% bracket, but only that income above 47,150 is being taxed at 22%, not the entire 50,000. So marginal tax is just the percentage paid on that next $1,000 of income. And Drew, I think I've heard you say this in the past that tax brackets and marginal rates are one of the most misunderstood things for your clients.
There's no doubt. I'll never forget the day that it dawned on me that clients thought that if you said to them, well, you went up into the 24% tax bracket, that they thought they were paying taxes now on everything at 24%. But like you said, $50,000 of income put you into the 22% bracket. But the way we compute that is with the first 11,000 is taxed at 10%. The next, what is that? $36,000 taxed at 12%. And the last 3,000 approximately is taxed at 22%. And the marginal bracket is that last $1,000, what's a tax bracket? Well, now, if I said to you, Alec, hey, you're single and you made 100,526, you would say, well, I just moved into the 24% tax bracket. But I would say, no, you didn't. You possibly went up into the 1,100% tax bracket. And you say, what? 1,100%? Yeah, because the last $1,000 you made just cost you something in the neighborhood of $1,200 in Maryland income taxes. So if you make $1,000 more between $99,500 and $100,500, it just cost you $1,200 in Maryland income taxes for just $1,000, right? So that's like a 120 some percent tax bracket. And the tax laws are weird that little jumps of income can actually come in with a monstrous marginal tax bracket in certain quirky little places in the tax code.
Yeah, there's lots of those, we call them cliffs, that if you go just $1 over, you go right over that cliff and lose an entire credit or deduction.
And then they're not so many of them that you're constantly going over them, right? But there are enough of them out there that if you don't know they exist, you could literally cost yourself a lot of money for just a very small amount of extra income that you just made.
Yeah.
Anyway, that's what we're talking about.
So gift tax versus income tax. The marginal tax brackets have to do with income taxes. Gift taxes are a completely separate tax system from income taxes. So, what do I mean by that? Gift taxes is really a gift or a state tax. Doesn't have to do with income you're making now. It has to do with after you've passed away. So, with gift taxes, there is this thing called an annual exclusion limit. And that annual exclusion limit this year is $18,000. Next year is $19,000. So you're allowed to gift $18,000 without having to worry about anything. Now, you can go over that $18,000 and keep gifting, and you're not having to pay taxes on gifts over $18,000 because there's something called a lifetime limit, and that is 13.61 million in 2024. So for a lot of people, they never have to worry about this gift or estate tax because the gifts they're giving aren't going to total over 13 million in their lifetime. And that lifetime limit doesn't apply if you're gifting to your spouse or qualified medical institutions or qualified educational institutions. So when we say, oh, I'm going to give my child $25,000, a lot of people come to us and say, do I have to pay tax on it? Do they have to pay tax on it? And the answer in most cases is no. If that annual limit is 18,000 and you go over it, as long as you don't go over that 13.61 million in your lifetime, you don't have to worry about that gift tax.
Yeah, it's the most confusing part of the tax laws because most 99% of people have never heard of the gift and estate tax. They don't even know it exists. But it's so when they hear about this annual limit of 18,000, they immediately associate it with income taxes and that their children are going to pay taxes on what they give them if they go over that limit. And you're right, it has nothing to do with it. It has to do with you giving more than 13.6 million in your lifetime and at death cumulative to a non-spouse beneficiary. 99% of people, 99.9% of people aren't going to ever exceed those types of numbers. So that's good. Very good slide there, Alec.
Yep. So jumping into our tax tips, the first one we want to talk about is just optimizing tax buckets. And what do we mean by tax buckets? There are different accounts you can open that have different tax categories. So the first being a Roth. What a Roth is you pay the tax now. So it's funded with after tax money. But then once in the Roth, that money starts growing tax free. And there are a couple of rules, but typically if you have the account open for more than 5 years and you're over 59 and a half, that withdrawal is going to be completely tax free. All of those earnings are tax free and all the contributions are tax free. On the flip side of that, there's a traditional account or a pre-tax account. The money goes in and you get a tax deduction. So you avoid any taxation initially. That money then does grow tax deferred, but then when you go to take the money out, that's when it becomes taxable, the money that you take out. That last tax bucket is an after-tax account. So in an after-tax account, there are no deductions going in, there's no tax coming out, but instead you are taxed each and every year on any capital gains or dividend and interest income in that tax bucket. Typically, it's in like a joint brokerage account, things like that nature. So we want to try and optimize funding these different accounts, and every situation is different, but some of these accounts can be very powerful when combined with each other.
Yep, good point. Very good point. We wrote an article about everyone needs a Roth strategy. It was written 5 years ago, but it's such a straightforward article. It's still applicable today. Everybody needs a Roth strategy, Alec.
Everyone does. And if you expect taxes either to be the same or rise in the future, you want to make sure you're funding that Roth because then you're locking in the tax rate today. And in the future, if your taxes are up, tax rates are up, you still have that Roth and you can take money out tax free. On the other hand, if you are expecting tax rates to fall, you'll want to contribute to a traditional account. And a big scenario where that happens is if someone moves from a state like Maryland that has a high income tax to a state like Florida where there's no income tax. Then you might want to start funding that traditional, take that tax break in Maryland, and then not have to pay taxes on it when you move to Florida.
Right.
So the next tax tip is contribute to that Roth 401k. A lot of people will contribute to their Roth IRA each year and not even know that their company offers what's called a Roth 401k. It operates similar to the Roth IRA, where money goes in after tax and then it grows tax free and distributions are tax free. Well, the Roth 401k is completely separate from the Roth IRA. There are no income limits like the Roth IRA. So even if you're making over the $230,000, you can still contribute to that Roth 401k up to the full max.
Also, Alec, a lot of clients think that if they move to the Roth 401k, they won't get the match from their company. That's not true. You can get your match whether you do the traditional or you do the Roth. So you still get the match. And I wrote another article. I called it Alcohol, Candy, and Tax Deferral. And it was basically about how each one of those really feels good when you're doing it. But if you do too much of it in excess, it really ends up being more painful to you in the long run,
Yeah.
detrimental. And the same thing is true with people who are tax deferring, tax deferring, tax deferring. It can be extremely detrimental long term.
Yep. So the next tax tip is to consider Roth conversions. We're going along the same theme here of everyone needs that Roth strategy. Everyone needs to find ways to get money into Roth accounts. And Roth conversions is another way on top of contributions to get money into Roth accounts. The difference between a Roth contribution and a Roth conversion is a Roth contribution is, like a Roth 401k. It's coming out of your paycheck after tax, or the Roth IRA where you're writing a check and depositing it into your account after tax money. Pretty simple. Roth conversions, on the other hand, is when you take money out of a pre-tax account and move it into your Roth account. By doing so, you're creating a tax liability. So you're creating ordinary income when moving money from traditional over to Roth. And what you're doing is while you're paying that tax, you're locking in that tax rate, and then the money starts growing tax free into the future. With Roth conversions, you have to be strategic. Drew, you and I have sat down many times together looking at different scenarios of these Roth conversions. And if we do this, we lose this credit. And if we do this, we pay this rate. And there are so many different ways you can do Roth conversions. There's no one size fit all for this.
And I hear that too often in the community, people saying, oh, tax rates are going up in 2026, so I got to do Roth conversions, and I'm going to get it at a discount. Well, that's ridiculous because, like you were showing a little while ago, if you do maybe $100,000, you could have just pushed yourself into the 28% tax bracket. And now, even if they do let the old laws come back into play, the max bracket you would have probably been in would have been 25%. So, I hear this too often, one size fits all. Everyone needs to be doing because you're going to get a discount and things like that, or rates are definitely going higher in the future. I have no idea. I just know I want to strategically think it out for each and every client. And we have a very sophisticated program that uses sort of artificial intelligence to analyze the tax return to see how much we can convert without triggering these landmines that we talk about.
Yeah. And when thinking about Roth conversions, you have to think about filling up those buckets of different tax rates. And as your income is lower and you are in lower tax brackets, you really want to be aggressively accumulating money in Roth. Like a lot of people in the beginning of their careers, we really suggest they do Roth contributions over pre-tax because their income is expected to rise. They might not see those lower ends of the tax brackets anytime soon. And then as you move up the tax brackets, you have to be more considerate of what you're doing with those Roth either contributions or conversions. Drew and I just worked with a client and we found we were able to convert about $10,000, $15,000 completely tax free because of where their income was. So those are the scenarios that you really have to look out for of if you don't even analyze it, you might be missing out on tax-free money going into that Roth.
There's tons of people, Alec, that miss that. Tons of people, especially those that don't have somebody like us, looking at the situation and analyzing it and especially that's why we like to do the tax return for the client is that we can see these things and say, okay, here's what we need to do to take advantage of this. So very important.
So the next tip is something that we've already discussed ad nauseum today, is staying under those cliff tax breakpoints. And there are a couple of them, but some of the big ones we've already mentioned is that $100,000 mark in Maryland. But the other sort of $100,000 mark in Maryland is if you're over 65 and single, or if you're over 150,000 and married. That is a big one that a lot of people don't know about because I think it's new in, was it 2022, the tax credit for seniors. That's a big one that if you just go $1 over, you lose the entire credit.
Yeah, that's I don't even know how it's legal that they can do that. Married couple and they make 150,000, $100, and all of a sudden it costs them $2,000 in Maryland income taxes because their income was $100, $100 higher than this supposed cliff. I can't even I can't even fathom how it's legal, Alec.
Yeah.
And there are tons of these. And I mean, I say tons. There are plenty of these in the tax laws. The IRMA surcharges are all cliff vesting, and so forth.
Yeah. And one tip that we're moving into that can help get under these cliff tax breakpoints is creating a tax efficient portfolio. And in that portfolio, if it's an after tax account, there could be capital gains, dividends, interest that then push you over these limits. So by creating this tax efficient portfolio, you can then hopefully stay under some of these limits. So for example, ETFs versus mutual funds. Mutual funds at the end of the year will kick out what's called a capital gain distribution. So when that fund manager for the mutual fund is buying and selling companies throughout the year, if there's a capital gain from doing so, they'll have that distribution at the end of the year for all the investors. ETFs, on the other hand, are more tax efficient than mutual funds, and you don't see those big capital gain distributions at the end of the year. The other thing you have to consider is different investments in different tax vehicles. So things like municipal bonds in a brokerage account. Those items are tax efficient, but you always have to look at the yield for those bonds. Just because it's a muni bond, it doesn't mean it's better than an after-tax bond. You can do a calculation to find if that muni bond is giving you a higher yield after tax than a typical bond will.
Yeah, that's a great point. And ETFs are far more tax efficient, and yet not enough people are using them like we have been aggressively using them over the years. So good point.
So the next tip we have is maxing out a health savings account. And an HSA is probably one of the most powerful accounts that you can maximize because with an HSA, contributions are tax deductible like a traditional IRA. Withdrawals are tax free like a Roth IRA if you're using them for healthcare expenses. So you're getting that double tax benefit. And then if you're funding this HSA through your paycheck, you're avoiding all those payroll taxes as well. So it's one of the most powerful accounts you can have. And it's different from a flexible spending account in the way that the HSA doesn't reset at the end of the year. You can let this HSA continue to grow into the future. And there are a couple different strategies you can use with the HSA to have it accumulate, invest it, and let it grow for later in life.
Yep, I do that. I just pay after tax and just continuing to let the health savings account continue to grow. And I can even go back, Alec, and pay all the bills that I've deferred for the last 5 or 6 years and take it out 100% tax free if I wanted to right now. So they're very powerful and very flexible to use. And don't confuse it with a flexible spending account, right? Work, flexible spending account. Don't
Mhm.
confuse the two. This one you can put in 8,300 as a family. It's cumulative and it's yours forever and ever as long as you use it for medical care. It's tax free. Flexible spending account, it's the 2,700. It's use it or lose it. You can roll over only 500 per year. You got to go to the company to ask them for the money. The HSA, none of that is, you don't have a nanny police, as I like to say,
Yeah.
for the HSA. You get to make your own decisions. If the IRS questions you, you better have good proof that you used it for healthcare, but otherwise, it's strictly your decision when to take money out.
Yep. So the next tax tip is doing qualified charitable distributions. And what a qualified charitable distribution is, it's also known as a QCD. And what this is taking money out of a pre-tax IRA and giving that money directly to a charity. And when you do it like that, that money comes out from a pre-tax account, completely tax-free to you, completely tax-free to the charity. So it's a very powerful tool that you can take money out of pre-tax accounts and make it tax-free. You can only do this if you're over 70 and a half. But once you are over 70 and a half, you can start doing these QCDs directly to charity.
Who celebrates their 70 and a half birthday, Alec?
People that are excited about QCDs will celebrate 70 and a half.
January is my half birthday month. Do you know what your half birthday month is?
August.
Okay, well, you know,
I
did
can't
you?
say I just didn't do that in my head as we're talking now, but
Yeah, there you go. Well, so you were born in February.
yep.
Okay, there you go. So everybody out there, think about when your 70 and a half birthday month is.
Yeah, just a few more years for me and I'll be able to do this strategy.
Few more years. There you go. I don't have long to go till I'm doing that.
Yeah. So another tax tip for charity is something called a donor advised fund. And what a donor advised fund is you can make donations to this donor advised fund that you control. And when you make this donation to the donor advised fund, it is a tax deduction in the year you make that donation to the donor advised fund. So, where this works very well is when people bunch their charitable contributions of a couple years into this 1 year, they donate it to the donor advised fund. And then once the money's in that donor advised fund, you then decide how the money goes to the charity afterwards. You can distribute it over 1 year, 3 years, 5 years, 10 years, 20 years. It doesn't matter how long you take to distribute the money, but you do get that tax benefit right up front in year one.
You want me to say something about that?
No, I'm going to cue you up in a couple slides here about another cool strategy with.
Donor advised funds, though, are pretty cool. I use those myself and constantly taking highly appreciated assets out of my accounts and moving it into my donor advised fund for charitable giving. Very cool concept.
Yeah. And then one thing we just want to keep in mind for everyone is you do need receipts when you're making these charitable contributions. So you want a receipt that says no goods or services were received for this donation from the charity you're giving to. You need that in hand when you file your taxes. You can't make a donation, take the tax deduction, and say, if the IRS ever audits me, I'll go back to the charity and get that receipt. You need to make sure you get that receipt when you file your taxes.
That's true for QCDs too.
Yep.
qualified charitable distributions. Even though the check comes out of your IRA to the charity, if you don't have that receipt, they make it taxable income to you.
Yeah. And if you have a single gift over $250, you need a specific acknowledgement saying the date of the contribution in the amount for the check. And if you're doing more than $3,000 in a single year, you need a letter from the charity on letterhead containing all of the information above.
Good point.
So, Drew, you had just mentioned this donating appreciated stock. How does this work in the sense of a donor advised fund?
That's teeing me up, right?
That's teeing you up.
There you go. So I buy Apple stock 10 years ago for $10,000 and it's now worth $100,000. All right. So I've not paid taxes on $90,000 of my Apple stock, or I haven't paid tax on, let's say, 90% of whatever I own in Apple stock. So I take $10,000 of Apple stock and put it into the donor advised fund. And even though I've never paid taxes on that $9,000 of gain, I still get a full $10,000 deduction on my income tax return. Okay. And poof, the gain on that stock disappears, but I still get the full deduction for it. I mean, it doesn't get better than that, Alec. A lot of people might be missing why I'm so excited about that. But like you illustrate here, if I take 10,000, it's worth 30, and the capital gain was 20,000, at the bare minimum, I would have owed $3,000 in tax on that if I sold it and then gave it to charity. But here I get the full $30,000 deduction without having to pay that capital gains tax. And you were being generous there because you guys are in the state of Maryland. And if Maryland were to see a $20,000 gain, they'd want another $1,600 on top of the $3,000. So it would really be more like a $4,600 tax that you're saving and not just a $3,000 tax. But, the higher the appreciation is, the greater power gifting appreciated stock into a donor advised fund is. And one of the beauties of donor advised funds, Alec, is that A, they know how to give you a receipt, so you don't have to worry about whether you get a good receipt or not. And B, the donor advised fund, you don't have to gift the money to charity right away. You can hold on to it for a long time. And C, if you want to give money to a charity without them knowing who gave it to them, you could do it completely anonymous. And there's reasons to give to charity anonymously, because you already got your tax deduction when you gave it to the donor advised fund.
Yeah, and the other cool thing about donating appreciated stock is in this example, if the stock is currently worth 30,000, you make that donation, you can take 30,000 of cash and buy that stock back. So you can still hold the stock, but now you essentially reset your basis. So any growth from there is only taxed at what you bought it for again. And then in the future, you can just donate again and do the same process over again.
And what we do a lot of times, Alec, is we'll have a client come in and maybe they're big donors over 2 or 3 years, maybe they'll do $100,000. So we'll say, okay, let's take 100,000 today and put it in the donor advised fund with appreciated securities. And then what we'll do is we'll take that big $100,000 deduction this year, but we'll then convert 100,000 of Roth IRA money, and boom, the charitable itemized deduction will offset the income tax on the conversion. And in essence, we kind of get 100,000 into a Roth IRA without paying any more in taxes than what we would normally pay in taxes.
Yep.
So there's lots of cool things you can do here, is if you have the strategies as to how to do it.
Yeah. So coming down to our last couple tips here is contributing to a 529 plan for children. So a 529 plan is a savings plan for education. And the deduction varies state by state whether one, you can take a deduction, and two, the amount of the deduction. So that just depends on which state you're living in, and it's only a state tax deduction, not a federal tax deduction. But with a 529 plan, you do have to contribute by December 31st, but then that money starts growing tax free. And if you use for education expenses in the future, it's 100% tax free. The
Yeah.
other,
Yeah. Go ahead.
yeah, the other advantage with the 529 is there's a new rule that you can convert money from a 529 into the child's Roth IRA as long as they have earned income. There are a couple caveats to that. The account has to be open for 15 years. There is a lifetime limit you can do of 35,000. But that's a new rule that didn't exist before, that there were these unused 529 monies out there that now can be moved into Roth IRAs to continue to grow tax free.
Yeah. So Maryland allows you to do $5,000 per beneficiary deduction, but Pennsylvania allows you to do $18,000 deduction per beneficiary. And if you're married, it's literally 36,000 per beneficiary. So you can really, if you want to give a lot of money to your grandchildren, you can really put a dent in your state income tax, depending on the state you live in.
Yep. So to recap all the tips that we just went through to minimize taxes before the end of the year is, first, optimize those tax buckets, both the Roth, traditional, and after-tax money. Roth 401ks are a powerful tool to get a lot of money into Roth accounts growing tax-free. And then Roth IRAs, we don't have to do before 12/31. We have until April 15th of next year to do. Roth conversions, however, do have to happen before 12/31 to be counted in the 2024 tax year. Staying under tax breakpoints, so that $100,000 mark, that $150,000 mark, finding strategies to do so. Maybe instead of doing all Roth 401k, if you know what your income is going to be, you can do a little bit of traditional to stay under one of those cliff tax breakpoints and save a lot of money doing so. Or creating a tax efficient portfolio to help minimize any capital gains or dividends and interest coming to you in that year. Qualified charitable distributions, these are if you're over 70 and a half, charity, IRA money going directly to charity. Health savings accounts, this is money that goes in pre-tax, comes out tax-free as long as it's used for healthcare expenses. Donating stock, we just went through that example of donating highly appreciated long-term gain capital stock. This will allow you to not pay the capital gain, as well as take the deduction for the amount of the stock going in. Donor advised fund, you can donate stock into that donor advised fund, or you can donate cash into the donor advised fund if you don't have stock to do. And you still get that deduction up front, but then you get to decide how often you want those flows to charity to go. And then lastly, contributing to 529 plans for children. You can take that deduction depending on the state and then have that money grow tax-free for the child's education.
Yep. You know, that stay under tax breakpoints, I was just running through my head all the different breakpoints. And basically, if your income is anywhere between $10,000 and $450,000, you've got a lot of breakpoints. You got the earned income credit, you got the retirement savers credit, you got the Maryland tax credit, you got the American Opportunity Credit, you've got the Roth IRA limit, you got the student loan interest deduction credit, you got the child tax credit, you got the qualified business income phase out, you got Social Security phase in and phase out, I just kind of rattled them off on the top of my head. There are a lot of them out there. So knowing where they are and having somebody strategically think them out for you is incredibly important. And then doing all the rest of this stuff to try to keep below these breakpoints and make sure you don't go over them in the future. Excellent stuff there, Alec.
Yep. So if anyone has any questions and you're already a client, you can reach out to your primary advisor. They'll be happy to answer anything we went through. You can always reach out to Drew or myself personally. We'll be happy to talk as well. If you're not currently a client and you're interested in becoming one, you can either scan that QR code on the screen to schedule an intro with us or visit us on our website at financialconsulate.com. So, on behalf of Drew and I and the entire team, we hope everyone has a wonderful and
Wait a
safe
minute. I'm
Thanksgiving.
not finished.
Okay.
I'm not finished. All right. Yeah. So, yeah, like I'm 67 this year. And, for the last 30 years of my career, I've been fighting for financial advisors to be more holistic, more thoughtful, and more like general practitioners of medicine. And the only way that this industry is going to change from a sales orientation to a holistic model where they're not trying to sell a product, but they're trying to help a client with all these tax things and so forth, is if the public insists that their advisor be a holistic, fee only, experienced, educated in all areas of personal finance. And I think we're at that time where we're getting to that tipping point that the public's saying that I don't want to be sold a product. I don't want you to work for commissions. I want you to understand taxes. I want you to be holistic. And, all of our clients out there who know who we are, know what we do, they're the ones that can help us the most to get the word out to the public that this is what they should want to. Whether they work with Financial Consulate or not isn't the point. The point is that the public start insisting that their advisor be holistic and looking at the comprehensive and not being concerned about commissions and sales and how much money they're making, et cetera, et cetera. So I'm finished now, Alec.
Yeah, that's great information. And I think a lot of people don't know what to expect from their advisor until they meet with someone like us or any other comprehensive fee only advisor that really is working in the best interest of their client.
That's why we do the financial physical, because when we do a financial physical, people say, wow, I've never seen anybody talk about my personal finances like you guys just did. And, they're going to Merrill Lynch, they're going to Morgan Stanley, Wells Fargo, Vanguard, whoever, Edward Jones, Raymond James, they're going to these companies and they're getting, some investments and they think, he's a really nice guy and he gives me, he's really helpful or she's really helpful or whatever the case may be. But when they do a financial physical with us, they're like, nobody's ever told me about all this stuff that I could have been doing, thinking about, and so forth. So I think we're at that tipping point, Alec, and I think the public's going to start demanding it. And the only place I know you're going to find an advisor like that is with NAPFA.org, NAPFA, National Association of Personal Financial Advisors, only organization that holds their advisors to the standard that we discuss: experienced, credentialed, fee only, holistic, work as a fiduciary at all times. And yet 300,000 people say they're financial advisors out there. What are there? 4,000 members of NAPFA?
Yeah.
That's a pretty sad commentary. We had Dr. Riley Moynes in recently. He was talking about retirement, the 4 phases of retirement. And we gave him our book, The Financial Physical. And he was talking to Graham and he said, I really liked the book, but it depressed me. And Graham says, it's not supposed to depress you. Why did it depress you? He goes, well, because the industry doesn't do what he's talking about in this book and treating people like a doctor of personal finance. And so I think the tipping point is here, Alec. And I think that our clients and all those who haven't a holistic advisor who's a fiduciary are going to start saying, if you're not going to do this, I'm going to go find somebody who will. Anyway, now you can go ahead.
Yeah, so I was just thanking everyone for watching, and I hope everyone has a happy and safe Thanksgiving. If anyone has any questions, please reach out.
And we'll have another one before Christmas, right?
We will.
So we'll wish them a Merry Christmas at that time,
Yeah.
or whatever holiday they want to celebrate, right?
Yeah. All right. Thanks, everyone.
Bye.